So now we go back to our futures contracts that we were studying. So please remember what we were studying here. The important things we studied here about the three important dates: last position, first position date, first notice date, and first and last delivery date. You really have to be more concerned about the last delivery date if you're making delivery. Okay, so conceptually understand it, although you will not be required to actually, you may not be affected in all the contracts in this particular project, but understand the concept when you're studying futures. Okay, so first position date is the first date on which we have already covered this yesterday. Make sure you understand this. Okay, so therefore from this we have a rule that follows that if you don't want to take physical delivery, if you're a speculator, okay, you're going to be functioning as a speculator. Okay, even though you in certain cases you may get a hedger designation, but we will assume that you're a speculator. So, and if you in any case, if you want to avoid, even if you're as a hedger, you want to avoid, the main thing is that this is the main thing. Okay, if this is your objective, that you don't want to be hassled, because physical delivery is a big hassle. You have to take, if it's cattle futures, you have to take the cattle, you have to sell them in a physical auction. If it's oil, you have to take delivery of the oil. That means you're holding the oil in an oil storage facility. You have to sell it to somebody. That means you're dealing in physical oil. Obviously here it's much easier to trade, okay, because you can just, with 2 clicks you can get out of a position. All right, in a futures in a financial contract trading sense, you can get out of a position in 2 clicks. But if you're dealing with physical positions, it's much harder to get rid of them. Okay, the market is much less liquid. So all these oil cargoes and all that, there is a fairly active market, but it's never going to be as smooth as this. Here, if I want to buy euros against dollars, I just 2 clicks and I can buy the amount. Okay, so whereas transacting in physical amounts is much more complicated. So therefore you may not want to take, many people don't want to want to be hassled with physical delivery. So the rule basically is that if you're a holder of a short position, okay, you have to close before the last trading date. If you're a holder of a long position, this is more dicey actually, you have to take it before. If you combine these two, read the notices here, neat what it's saying. So you have to basically get out. If you're holding a long position, you have to either square that position or you have to take delivery against the position, right? Okay, and delivery is also aware of squaring the position. So if you have that, now if you don't want to take physical delivery, there are 2 concerns that you have. One is the last trading date, because obviously after the last trading date you can't trade, right? You can't trade after the last trading date. And also after the first notice date, you may or may not get assigned, but there is a risk that you might get assigned, because remember, what is first notice date? These are all in your notes. What is the first notice date? The first notice date, which is actually wrongly defined in your book, that exchange notifies the holder of long position of delivery intent, which means the first notice date, as soon as the first notice date comes, you're on notice, in the sense any day the exchange may come and catch hold of any long trader, any trader who's long futures. The exchange can randomly catch hold of him and tell him that you are going to be delivered against. You told them.
Yes, sir. But sir, please, sir, possibly or hand mic we have a meeting.
So where is the hand mic? We have a hand mic, no? Okay, we'll just live with it. Never mind. We'll just live with it. Okay, relax. Okay, so is this clear that if the first notice day is also dangerous, because after the first notice day, you could be assigned. You don't know, because it's not in your hand. The exchange is going to randomly select any wrong position holder and assign the contract, because on the basis of the short seller, those who are short after first position date, those who are short are already telling the exchange that I want to settle this through physical delivery, right? So the exchange already knows that there are certain physical deliveries to be made, that let's say in the case of 10 contracts there will be physical deliveries. So now the exchange is not going to sit with the physical delivery. The clearinghouse will not take the delivery. The clearinghouse is always, everything is in and out. Okay, they square everything. Okay, so the exchange is now going to hunt for 10 long traders to whom they are going to make those deliveries. They are going to assign those deliveries. Are you following what is happening? Okay, so physical delivery is going to happen because 10 short position holders have told the exchange that we want to make physical delivery. So now the exchange has to find 10 contracts held by long traders against to whom they're going to assign those deliveries, and they'll be doing that randomly. So if you're a long trader, after the first position date, you're running a risk that you could be assigned. Okay, are you following? Right? If you don't want to deal with physical delivery, that's not something that you want. Obviously, you don't want that kind of outcome, right? So therefore you should get, therefore the first, obviously you have to get out. If you're a long trader, you have to get out before the last trading date. Even a short trader also, you have to get out before the last trading date, because after that you can't trade. Okay, so and if you're a short position trader, if you have a short position and you don't have any intention of getting into physical delivery to settle it, then you have to get out before the last trading date. Okay, and if you're a long position trader, you have to also get out before. There's no question of you deciding to make delivery. You can sit and wait for delivery, but you can't, it's not in your control. So you also better get out before the last trading date, or you have to get out before the first notice date. So therefore, if you combine the last two conditions, these two conditions, if you combine, you have to get out here, okay, prior to last trading date or first notice date, whichever is earlier. Are you following the logic?
Yes.
If you're a long trader and you do not want to get into physical delivery, you have to get out either before first, whichever comes earlier, last trading date or first notice date. This is clear? Logic is clear to everyone? Okay? Yes? Okay. So this is just about delivery. Some of the points that you needed to know about delivery. Okay? And these definitions, first notice dates, this link, actually this is the better link. This is actually directly from the CME website. So anyway, you see any conflict between what is written in a book and what is written on the exchange website, you go with what is written on the exchange website. Okay, so this is the correct definition of first notice date, which is there on the CME exchange website. Okay, so these are important terms that you need to know with respect to delivery. We have also covered the other point yesterday already, that is, what is the settlement method? Is it cash settled or financially settled? Okay, or is it physical delivery? Okay, so that is another thing. So any futures contract that you are studying, one of the things you have to look out for is to find out what is the settlement method. Okay, is it through physical delivery? Is physical delivery allowed, or is it something which is, as we saw in the case of the S&P 500 futures, that physical delivery is not allowed? It has to be financially settled. Okay, so they will look at the value of the spot at the time of the last trading day of the futures contract. They'll look at what the spot value is, okay, for the same base asset, and they will settle against that. So if you have a higher futures price, okay, and you are long and you are having to sell it, you will have a loss. Okay, so if you are long at a particular, so whatever the spot value is, the spot value of the contract is, of the asset is, they will compare it with that and they'll settle it financially. So these are two aspects of this is an aspect of settlement method, okay, and which we studied yesterday, and then there's the aspect of delivery. So we go back to we already studied this. Asset is obvious. Contract size, delivery arrangements, we already discussed that. Delivery months, you saw that there are many different months that are trading. Okay, price quotes, price limits, position limits, we already discussed all this. Okay, this is the point that we did not discuss yesterday. Just read this here. Convergence of futures to spot price. This difference is called the difference between this. There's a term which is not mentioned in the book, okay, which we'll discuss here. I'm just going to write it in your futures note. So in this note for your study, which is in your folder, I'm just writing down particular notes on some points which are not mentioned in the book. Okay. What is it? This is also coming from. This is Garvit. He's talking on the phone. Okay, some voice is coming. Oh, some there.
Yes, sir.
Okay, very strange. Okay, so futures, because we have seen cases where in the past where students were actually, they would like slip in a big class, like 2 sections, like the first year classes. Some students would like slip down under the desk and talk on their mobile phones, and you would hear a murmuring sound, but you couldn't figure out who was actually talking. Okay. So what are we talking about? Futures, either futures minus cash or cash minus futures, whatever you want to call it. Okay. So this is called the cash. Sometimes it's called the basis, or this is called the cash futures basis. So we should write it like this. This is a term that you need to know, basis. Okay, so basis is a term that is used in finance for a lot of differences. Okay, difference between this and that. So this term is called the cash futures basis, which is at any point of time, if you look at the futures prices. Okay, and here you can see if we go directly from your maybe we can see it on, oh my god, they have blocked bar chart. Oh. Money control is also blocked. No, I'll tell them to, but actually the problem is that, you know, I figure out only like when I open it here and then I find. I'll send them a mail. I'll send them a mail again on this. So we'll just write this down here. I'll just write them as a reminder. But so many things are actually blocked. Bar chart.
So you can use a VPN to unblock all of them.
Yeah, but the thing with VPNs, don't they always slow down the traffic? VPNs don't slow down traffic.
There are certain which do, certain don't.
Okay, so what is a good VPN?
So like Siphon, it's a freeware. Then Skyzip.
Siphon is SIPHON. PSI?
PHON.
Okay, so I'll write it. So according to you, Siphon is a VPN which does not slow down traffic.
Yes.
This is the only reason I don't use, basically I can just use my geo, but...
extension as well named Skyzip. You can also use that.
Skyzip.
Yes.
Okay, good. All right. Okay. So, so the term that you're learning here is basis. Okay. So this difference between the cash price, I just wanted to show you because on bar chart you can see the cash prices, but unfortunately now we can't load bar chart. But here, if you see, if we just look at energy once again, we could have directly gone into this. But the point is basically that there would be a futures price and there will be a cash price, because the futures price is for a particular maturity. As you can see here, this futures price now, the crude oil is, if we can make this, is this big enough? Can you guys see at the back?
Yes, sir.
You can read all this, December 16, 19?
Yes, sir.
Yash, you can read? Okay, it's better on your WhatsApp. Looks better. Okay. Okay, so we don't need to increase the font size, but you can see here that the yeah. So right now the crude oil, the front contract is actually the Jan 2020 contract. Okay, so but there will also be a, so this is 57.85.86. So it's possible that the spot price maybe is something like 57. So if you are buying spot cargoes of crude oil, okay, those are probably 57. Okay, and the futures price, the front month futures price is the first month is called the front month sometimes. Okay, so or they'll just call it first, second month, etc. And so you can see here this is 57.85, and there will be a cash price. Let's say the cash price is 57. Okay, so that is for buying physical cargoes of oil. Okay, which is quite an actively traded segment. So now, so the difference between those two here, we'll say the cash futures basis is 85 cents. Okay, because the spot price is 57 and the futures price is 85. Okay, 57.85. So it'll say, we say the futures, cash futures basis against the first month is usually by default it is coded against the first month. So we'll say the basis is 85 cents. That's all. It's just a term that you need to know, cash futures basis. Okay, which is okay, so just the term that we wanted to add to your where did I write? Oh, it was written in your futures notes. Okay, right. So the term that you've learned, this is called the cash futures basis. And so what we are learning here is the convergence of the cash and futures prices. So spot price is basically, we also call it cash because we are contrasting it with the futures contract, which is a derivative contract. So anytime we are contrasting a spot price, okay, or a value cash price against the futures price, in both cases we'll refer it against any derivative price, we will refer to it as a cash market. Okay, so therefore that's why I said cash futures basis. Okay, normally the term that is used in industry is that, it's not spot futures basis, because cash is here used in the sense of cash market as opposed to derivative markets, which is the futures being a derivative contract, okay, is a derivative market. So you're comparing these two. So here you can see this. Basically what they're trying to show you is that as you get close to maturity, the two prices have to converge. Okay, so the near month futures delivery, the futures contract and the spot price, the two of them have to converge, okay, because otherwise there will be opportunities for arbitrage, although we have not yet defined what is classical riskless arbitrage, but I think you've got a flavor of it in some previous discussions. So just try to understand what they're saying here, that there are two possibilities. Let's say if the futures price is higher than the spot price, okay, very close to maturity, let's say we just artificially twist this diagram, and if we say that, what is the first example they've taken? Yeah, the futures is above the spot price during the delivery period, okay? So what happens? Or even very close to the first delivery date. So are you able to follow this? Because you know that this is only true for where you can deliver against the underlying contract. Okay, even in the case of financial futures, because the settlement will happen against the financial futures. But here they have given the example for against the spot value of the contract. But here they have given the example for physical delivery contracts. Okay, are you able to follow what he's saying here? Because the futures contract, in cases where physical delivery is allowed, okay, then essentially the futures contract is just a path to the physical asset, okay, because you can either buy the futures contract, you can buy, if you want to get hold of the physical asset, you can buy the futures contract and not wait and not close it out before first notice date or for last trading date, which means you're assured that there will be a delivery against you, okay. So therefore that is one way, so you can just wait for delivery to be made against your long position. So that's one way of getting hold of the physical contract, of the physical asset. The other way of getting hold of the physical asset is to directly buy it in the market. Directly buy a physical asset in the market. Yeah. No, the first part, you're not clear about the first part. So the first part is that if you buy the futures contract, okay, and you don't square so you're long a futures contract. Now you have not squared it before first notice date. You have not squared it till the last trading date also. Alright, so then you have an outstanding contract, okay. So in this case you are likely to get delivered against that contract because you have not, so because anybody, the short position holders who are making delivery, okay, so you will get delivered. So eventually what is the consequence? That the physical asset ends up in your hands because you bought the futures contract, you didn't square it, and so you got delivered. So the physical asset ends up in your hand. So that's the outcome that we are looking for, that I want the physical asset to end up in my hands. So one way for that to happen is to buy, the indirect way of doing it is to buy the futures contract and wait to be delivered against that position. That is the indirect way of doing it, okay. But the direct way of doing it is, if I want the physical asset and if it's obviously being traded in the market, there is a spot market for that, I can just go into the physical market and buy the physical asset. So there are two ways of achieving the same thing, okay. So if are you following? Is everyone clear? Okay.
Yes, sir.
Although only she asked the question, I'm sure many others were not clear, but people are not in the habit of asking questions. Okay, so now is this point clear? Now there are two ways of achieving the same outcome, that you can either buy the physical asset in the physical market, or you can buy the futures contract and wait for to be delivered on the futures contract. So there's also an indirect way of getting hold of the physical asset. So remember what we studied in synthetic, when we studied synthetic positions for options, okay, so the questions came up as to why do we bother with synthetics. Okay, the reason you bother with synthetics is that there are two ways of achieving the same outcome, then the two of them should cost the same. Otherwise there's an opportunity for arbitrage, because you can take the one which is low, cost less, and achieve that. You can buy that set of instruments, okay, which help you to achieve the same outcome, and the ones which cost more, you will sell that and then you pocket the difference, because there's no risk, because the outcomes are the same. Are you able to follow?
Yes, sir.
Okay, so if it is a if we are talking about a physical oil cargo, okay, then if there's an oil futures contract which is trading, the first example they've given is that the futures price is above the spot price. So what you see here, read what this says. Read what this says here. So you simultaneously, because in this case, what are we saying? We are saying the futures price very close to delivery, okay, very close to the start of the delivery period. The futures price is just another way of getting hold of the physical asset. The futures contract is just another way of getting hold of the physical asset. So if I see that the futures contract is much more expensive compared to the spot price of the physical asset, the same physical asset which will be delivered into the futures contract, which is deliverable into the futures contract, right? If I see that it has much lower, the spot price, the physical price is much lower, okay, but the futures price is much higher. But if you are very, very close to the start of the delivery period, then these are actually essentially the same things. Because if I buy the futures contract, if I buy the futures contract, I can get hold of the physical asset indirectly, because it will be delivered against my long position if I don't close it out. Yes? Are you following? So what we are trying to say is that very close to the delivery period, okay, or within the delivery period, there is the two are actually essentially the same thing, okay, because you can switch one for the other. Here what they're talking about is an example where, if you see the example where, so there are only two possibilities: either the futures is above the cash or the cash is above the futures. There are only two possibilities, and what we are saying is that eventually the cash futures basis has to go to zero, okay. And this is what they're talking about, the convergence, okay. What are they showing you here? This is the convergence that they're showing you as we approach the delivery period, okay, that the two will converge, okay. So what are they saying here? The first example is where the futures is higher than the cash, okay. So since you're saying that essentially the main thing to understand is that very close to the delivery period, these two are essentially the same things. Since they're essentially the same outcome basically both are roads to the physical asset, okay, either the selling or the buying of the physical asset, okay. So in this case, what are you doing here? Essentially you are buying the two are the same, you're trading the two as the same, and you see that the futures contract and one of them has a higher price. So the law of one price, which we have not yet discussed classical riskless arbitrage properly, okay, because it's slightly longer discussion, but the point here is that if two items are the same, they can't have this two different prices, right? So if you see, for instance, any product, let's say if you see that sugar is selling in one market in say South Delhi for, say, let's say 40 rupees a kilo, and it's the same grade of sugar, and you're able to buy and sell at the same price. If you are able to buy and sell at the same price, okay, and then you are able to transport that, assume that there's no transport cost, okay, if you are, and that same market is selling, and the same product is selling in North Delhi at 50 rupees a kilo. So what will people do? Since you can buy and sell at those same prices, okay, that is both the bid and the offer, so it's a choice price. So they will buy the sugar from South Delhi and sell it in North Delhi, right? Because the price in North Delhi is much higher, and two items can't have the same price. Are you able to follow this? Simple. So we are actually discussing classical riskless arbitrage without the transportation cost. Or even if we add, let's say 5 rupees per kilo, the transportation cost. So the South Delhi price is 40 rupees a kilo, alright? And the North Delhi price is 50 rupees a kilo. So actually what we are saying is that there is still an opportunity to make money, because you can buy it at 40 rupees, pay 5 rupees for transport cost to North Delhi, and then sell it in the North Delhi markets at 50 rupees. So you're still making 5 rupees. So that's what we are saying. So eventually what will happen when you have this is that if we see this as a, maybe we should just do this and then we can cover arbitrage in your okay, so let's have this in this sheet itself a little bit lower down, okay. Alright, so if we are saying that in South Delhi the price is, let's clean this up, so remember this. So if we say that the price in South Delhi is 40 rupees a kilo, and then there's a transport cost of 5 rupees, and then the price in North Delhi is, say, 50 rupees a kilo, alright. So here what we are saying, and the product is the same, okay, and since you can easily bring sugar from north to south, south to within Delhi, you can easily transport the sugar, okay. So then what we are saying is this price is, since these two are the same identical product, okay, so they can't have two different prices. If there is a different situation that prevails like this, so what people will be doing is they will just cover this, so they'll just have this plus this, and then they'll be able to sell it here and make a profit, okay, of 50 minus 45. All right, so we can say another way of using the synthetic concept, okay guys, let's focus on our job. So another way, now you remember what we discussed in options when we are talking about synthetics, okay? What is the synthetic equivalent of a long call position? Okay, what is the synthetic equivalent of a long call position? All right, and then one minute, what is the problem? Okay, so what we are saying is that the synthetic fair value of sugar in North Delhi should be 45 rupees per kilo, not 50 rupees, because I can, in a synthetic way, that is not the natural North Delhi sugar, okay, not the natural North Delhi. Why are we calling it synthetic? Because this is an artificial way of giving a price for North Delhi sugar, because the actual price is 50 rupees a kilo, but it's a synthetic price. We see the synthetic fair value should be 45 rupees, because I can buy the same sugar in South Delhi and transport it for 5 rupees a kilo, and so that will only cost me 45 rupees. Okay, so the fair value of sugar in North Delhi, for synthetic price of synthetic fair value for sugar in North Delhi, it should be 45 rupees, and therefore if the actual price is higher than the synthetic price, so this is actually a case of what is called fair value modeling. Again, you see essentially what you're seeing is what does it cost me to when you're looking, now this is the market price, okay. Now once again you can remember, go back to your framework of comparing fair value versus market price. This is a fair value. So all these models that you have done, your Gordon growth model, every other model that you do in equity valuation, okay, those are all fair value models. Your project IRR, project NPV, all of those are actually fair value models, okay, and they're all subjective because they're based on your subjective forecast of the cash flows, of the returns. We don't want to use a specific term like cash flows. It's basically returns, okay, which is the more general term. So all those fair value estimates are subjective, okay. So if we go back now, we can combine this discussion with a discussion a little bit about the models. So I think basically we can, which I had not planned to do, is while discussing this topic of convergence of futures, cash futures basis to zero, we might as well discuss the concept of classical riskless arbitrage, okay, and what is really arbitrage free valuation, okay, and why maybe we can even discuss if we have, I don't know if this thing is able to open over here. Okay, we'll wait for this to open. So let's so let's go back to the DP4 paradigms, okay. So what are we discussing? Now these are all fair value models. So understand the fair value models, you have to always understand that what you're getting out of a model output like this, it's a subjective fair value assessment, which is your assessment, somebody else's assessment could be different, okay. But there's something which is which always has to be considered whenever you're applying a fair value model, which is what is the market price, because remember the market price is not subjective. The market price is always objective, okay, like what is the market price of dollar Swiss right now, okay, you can see the market price is this, okay. So what is the price of here, they haven't given the price figures, but if you just open this, you'll see the price of crude oil, okay. So whenever you're discussing, if you go to quotes, you'll see this, okay. So whenever you're discussing fair value models, you have to always keep in mind the other thing, which is the objective data, which is the market price. You have to compare your fair value to the market price, okay. That's how these models work, okay, that the fair value is compared to the market price. So you have to understand the overall framework. Remember that all these things don't just fall out of the sky. Now we are doing valuation, okay. Why are you doing it? What is the fundamental decision problem that you're trying to solve? Buy or sell, okay. So you have to understand that those are generic decision problems which will always exist, okay. So the main reason you are trying to apply this kind of model, what is the context in which this fair value model is being applied, it really is to solve the buy-sell problem, which is really the problem, okay? This is really what you're concerned with, which is why, as I said, you have to always understand it in this way, that while you're applying a fair value model to solve the buy-sell problem, also never lose sight of the fact, like Chugh mounted a stern defense of technical analysis in his interview, okay? So the other thing that you should not lose sight of is that the whole buy-sell problem can be solved without any reference to fair value if you are using technical analysis, because in technical analysis we generate buy-sell signals by looking at chart patterns and using other kinds of indicators. It's a vast field by itself. You can have 3 courses on technical analysis, including building trading systems, okay? So that also should not be lost sight of, okay? Fair value, always discuss market price, always understand the context, that is to solve the buy-sell problem, and also always remember that TA is one way of solving the buy-sell problem without any reference to fair value, okay? Just by looking at previous chart patterns and things like that, and other indicators, all derived from the price, okay? All you're concerned with is price. That's why we say TA is a value agnostic approach. It's a fair value agnostic approach. Agnostic, you understand? Agnostic means don't know, okay? So one way of defining, it's not very commonly defined in this way, one way of defining people who are religious, or distinguishing between religious people, atheists and agnostics. So religious people have a faith, like they believe in Jesus or they believe in Muhammad or whatever, but atheists are convinced that there is no God, okay? Whereas agnostics are not sure. Yeah, and they are not really particularly concerned with that, and essentially they are saying that we are not sure, okay? So therefore, coming back to this, so understand that all your NPV, everything falls under this. Why do we call it forecast based valuation? Because these are all based on forecasts, okay? Stocks, you're forecasting the returns and discounting it, okay? So everything is a forecast, project NPV, IRR, okay? I have not written the IRR part here. IRR is also should be written here. Maybe we can just write it here. All right. Okay, so project NPV, IRR, all this stuff is, all these are fair value models, okay? So always compare it with the price. Now what was the discussion we were having? Yeah, okay, coming back, so understand that this is the context is basically I'm concerned with solving the buy-sell problem. Should I buy this asset or sell this asset, okay? So now come back to North Delhi, okay? So now I look at the North Delhi sugar market, okay, and ND sugar, and this is South Delhi sugar, okay. So this is, I'm looking at the North Delhi sugar market and I'm asking myself this question: should I buy this market or sell this market, okay, at 50 rupees a kilo? All right, this is clear. Now I have a decision problem: should I buy or sell this asset? Now what do I do? One of the things I can do is I can apply an example of what is actually called, we have to go back here, maybe I should move it a little bit. Hopefully it's close by now. One more. Okay, so where were we? Okay, now look at this. We are going to apply, now you'll see an example of this, okay? And we'll make all the distinctions, we'll have all these discussions in one place. Right, so what is the schema here? On the high level, we have a distinction between value versus price based analysis and things like TA, which is value agnostic, okay? So now that's the first level distinction. Now we are looking inside this value versus price based. So everything that is here is all based on this scheme of value versus price based comparison, okay? And remember, what is the underlying decision problem? Whether I should buy this asset or sell this asset, okay? So maybe we should even make this fair value, okay? Yeah. Okay. fair value versus price. Okay, so this is our basic schema. What are we going to do? So this we are trying to use this. Now the model we are trying to use here is now actually this, what I call arbitrage free valuation. So here you can see within this approach there are two approaches. One is forecast based valuation and one is arbitrage free valuation. Okay, and arbitrage free valuation I've further divided into two parts. Okay, one is proper arbitrage free valuation and the other one which is improperly so called, which is basically all option valuation models which are using the tools of arbitrage free valuation, the techniques of arbitrage free valuation, but it's actually not real arbitrage free valuation, and you'll understand why once you understand what is pure AFV. What is a classical case of AFV? You'll see this, and so we'll see this in the case of. So what we are doing is we are going to solve this problem of North Delhi sugar by applying this framework, pure AFV, proper arbitrage free valuation. Okay, and what is it? How does this? So understand how this overall framework is going to work, because this is a subclass of this overall framework. So this overall framework, how does it work? Any market, we look at. How does the framework work? This is market price and this is fair value. Okay, so this is the fair value versus market price framework. And what is the decision problem? Buy or sell. So what we will do is we will see market price, everyone can see.
Yes.
All right, the fair value we have to work out for ourselves using some techniques. Okay, so we'll come up with the fair value. Now we've come out here with the fair value. So the framework, the way it works is very simple. It's so simple, I mean it's very obvious. You may not even want to register it as a rule, but it should be, because you have to always think in terms of how you would talk to a computer. Okay, for a computer everything has to be spelled out. So the rule is basically that if, we can write it here itself, if fair value greater than market price, then what should we do? Sell or buy? Buy. Is everyone clear? I think everybody was not clear about this. So if fair value is greater than market price, then you should buy. Yes, Gulati, are you following?
No, sir.
You're a little lost. Yeah, I could see that. What is the problem?
Sir, I'm unable to get this concept.
So then it's your responsibility to ask me. No, I'm not supposed to look at you and see that you are lost in some other space, outer space somewhere. It's your responsibility to pipe up and tell me, that you have not understood. Where have you got stuck? 1 minute. Yes. Where have you got stuck? Okay, then you revise it yourself and come back to me with question. Okay, we can't go and this is the problem, that if you say I can't understand anything, that means you are not paying attention. That is not acceptable. You have to say that, okay, you have taught 7 steps, I was able to follow till the 3rd step, and then from 3rd to 4th I couldn't figure it out. So that is acceptable. Okay, otherwise I don't know anything.
There should be fair value should be less than market price. Then only we buy.
Okay, let's see now. So we have a dispute. Between. Huh? 1 minute. No, 1 minute. Okay, so Tanya has raised an important point, so let's figure it out. So there is a battle between Tarun versus Tanya. Okay, yes. Huh?
I think
1 minute. Let's not only one person talk at a time. Yes, what is the problem?
so this is right.
So this is right?
Yeah.
Okay, so maybe if you do it visually on the chart, it's a little easier.
So because we expect the price, because according to our
We are
estimate,
taking 45 and 50 as the price. So you understand that whether 45 is better for you or 50.
Okay, but let's make it clear to everybody. Ritesh, you have understood? If fair value is higher than market price, then we will buy.
sir, in simple terms, you are estimated by forecasting the return and then discounting them. That is the thing, right?
No, fair value can be done in many ways. One
But
sec.
the way that we have learned in even in FDRM is first we forecast the return, then we discount them.
No. 1 minute. Let's be clear. 1 sec. Now, Chuk has made a statement which is strictly speaking not correct. It applies to only one class of fair value estimation methods. What are all these things? These are all fair value estimation methods. Okay. So, because when you are in this branch of the tree, you are always using this fair value versus market price comparison method. Okay, you are always going to be useful. So let's get this basic rule clear to everybody, cleared up with them for everybody first. Then we'll come to these. I'll come to your point. Okay. So because everything is within this branch of the tree, so all of these things have to fall under this method. Okay. And so it's a very obvious thing, but we are still making sure that everybody understands, because as we saw, it was sometimes not clear. So let's understand it visually with a chart. It's much better. If I'm looking at the dollar Swiss, okay, 99.89, 99.90. Okay. If I feel that the fair value of the dollar Swiss is 1.02. Okay, now what is the idea behind fair value? There is an implicit idea behind fair value is that the market will eventually move to the fair value. Okay, there is an assumption, not just go up, that's a specific for this particular case, but when you're doing fair value based methods, okay, so whenever you're in this branch of the tree, okay, like there are some people who are not even in this branch of the tree at all. Okay, they are always in this branch of the tree. They are purely technical traders. Okay, so this is actually not a very bad. I'll tell you my own story, like how your views can evolve. Okay, so when I joined, when I made up my mind to go into foreign exchange trading, I was driven by this idea that because I was an economics graduate, so I would understand, I would do major macroeconomic analysis, and I would forecast exchange rates. So when I first came into the trading room, I heard this story about a trader in New York, okay, who was actually trading in a room with no news. Okay, so he had blocked out all news. He had only charts. So he was a pure technical trader. Okay, and he was actually blocking out news because news is a distraction. Okay, so he didn't want to get affected by the news, and he had blocked out everything. So when I heard that story, that this guy was trading purely on charts, I thought that this guy must be nuts. Okay, so, and then this was just when I had started out in the trading room, but within 6 months of watching the price action, that's why I'm making you guys watch the price action, trade in the markets with real prices. But within 6 months of watching the price action, I had understood that he was right. Because now everybody may not come to the same, it's a way of, it depends on how you think. Okay, now maybe 10 other people who are exposed to the exact same experiences that I had in those 6 months may come out with a different view. That's because everybody's thinking differs, right? Some people some people are socialistic, some people are free market oriented. The facts are always the same, but it's because people's thinking differs, right? So in my case, I was convinced after watching 6 months of price action, actually trading, quoting prices, carrying positions, okay, losing money, making money. So then I understood within 6 months that he was absolutely correct. Because why is that? This is what will help you to decide between which branch of the tree you want to go to. Is everyone following what discussion we are having? Yes, sir. Okay. Now what made me understand that he was right is because I came to this conclusion, maybe we should just loosely write it here. Okay, this is where actually when we do the distinction between, this is the merging, right? When we do the distinction between, but this is such an important point, we might as well write it here. Market rationality. You understand what is meant by this? Is a very small thing here, but anyway, we'll try to make this maybe 8 or something, and we'll just center it. All right. Okay. And here, so why did I come to that? If I just put here, it's okay, I think. Yeah. And here in TA, we assume that we say that market, yeah, we say it's not irrational. This assumption is not required. Okay, so this is what I was trying to, this is why it's related to the, this is not big enough, but when you're looking at it at home, you can read it. But this is the fundamental difference between what will make you a technical trader. Why did I switch from being a fundamentals based person to a situation where I do look at fundamentals because I teach about fundamentals, I have an interest in the fundamentals, but if there's a conflict between fundamentals and technicals, I will always go with the technicals. Okay, always, because I don't believe that the market is rational. Okay. So rationality, understand what is the meaning of rationality? It has a very specific meaning because it means that this, if we go back to this, rationality, this is your estimate of fair value. Okay, rationality, the belief in market rationality means essentially that sooner or later the market price must come to the fair value. This is basically what it means, that you came up with an estimate of fair value and you believe that the reason you bother to even go through this exercise of coming up with a fair value, okay, is because you believe that whatever be the market price today, eventually the market must come to the fair value, either go down or go up. This is a very important belief you have to understand. Why do people do the things they do? That's because everything is driven by the belief system. Okay, so why did I switch my view? Because based on my assessment of what I saw in the market, I came to the conclusion the market was not rational. So therefore it did not make any sense to use frameworks which require the market to be rational. Is this clear? And what is the meaning of market rationality? Market rationality has a very specific meaning. It means that it is always associated with this kind of a framework where you're comparing fair value to price. And so market rationality implies that sooner or later, at some point of time, okay, the market must return to fair value, whether by going up or by going down. Is this clear? Yes? All right. Okay. So far you have understood these are all important concepts. Understand what market rationality, because you have to understand later on you may be required to make a choice between whether you're going to be a TA trader or you're an FA trader. Okay. Now there's also an element of political correctness in this. You will notice that many people in the industry, if you say that I'm a pure technical trader, that's not a politically correct statement. Okay, just like in the US, they have now made it politically incorrect to say that you support Donald Trump. So many people who support Donald Trump are actually keeping quiet because they're afraid of getting beaten up and attacked and all that. So they are keeping quiet. Okay, so because it's not politically incorrect. Okay, so this is the thing. So in the industry also, you'll find that there is a stigma associated with technical analysis that people don't like. So even if they use it, there are many people who use it. Okay, because fundamentals don't give you that much clarity. Okay, and technical is quite a precise method. So many people use it, but they won't say it. Okay, so like we had in 2016, there were stories that some guys who are going to vote for Trump, they didn't tell their wives that we are going to vote for Trump. So they would not say it. But people use it, but they don't want to admit to it. So there's a problem. So when you go out into industry, don't come out very strongly, especially in your early years, by saying that I'm a pure technical trader. That may not be a politically correct thing to do. So you need to protect yourself in your early years, okay, until you become established. So I would suggest, while I'm telling you this, that this is the real reason. The reason you would become a pure technical trader is you would be looking at the market and you would observe all the price movements and you would come to the conclusion that the market is not rational. Which means essentially what are you saying in pure form? It's a very simple statement in your mind. You have come to believe that there is no reason to expect. Now I do a dollar Swiss fair value analysis and I say that fair value of dollar Swiss is 1.02, okay, according to me. But because I'm a purely technical trader, what does that mean? I am convinced that there is no reason to believe that the market will ever necessarily go to fair value. It may or it may not. There is no reason to expect that. What is the fundamental difference between a TA, pure technical analysis person, and a person who goes to this side of the tree? The person on this side of the tree believes that sooner or later it has to come to fair value. You see the difference between the beliefs? Okay, there is a belief that sooner, it may take some time, whatever, okay, months, weeks or whatever, but it has to come to fair value. There is a very definite difference in the belief system. Are you able to follow that? Okay, whereas a TA guy believes that, well, it may or may not, I don't really know, I don't see any reason why it has to necessarily come to fair value. Okay, market price can go anywhere because the market is not rational, according to me. Okay, this is clear. So I'm not saying you have to subscribe to any of the things, okay, but I'm telling you what is the you will try to understand your own belief system, okay, about the market based on your own assessment of the evidence. You have seen the evidence firsthand. You're watching the market, you're watching real market prices, okay, you're trying to trade. So you will form your own view about what the market is. Like one of the students in IMT Ghaziabad told me that the market does not make any sense. He actually wrote, I made them write a report. So he says the market does not make any sense, which is actually fine. That's an assessment, right? So at least he has a clear assessment that the market does not make any sense, which means he probably doesn't believe that there is market rationality. right? So it's your assessment that you'll form your own assessment based on your reading of the evidence, okay, which you have before you. So this is the reason that will make you choose either this method or that method. But the other warning that I'm also giving to you from a practical point of view is that even if you believe that you want to be a pure technical trader, try to hide it a little bit in the industry. Don't come out and say I'm a pure technical trader, okay, because it's not politically correct, okay. So you say that, oh, I look at fundamentals, and that is what most people say in the industry. I look at both fundamentals and technicals. Actually, I can show you why it's not really rational to believe in both, okay, because it's like I believe in Jesus, but I'm also an atheist, that kind of thing, you know. So it's a problem, but this is what most people in the industry do. So here I'm now teaching you some practical tricks. When you go into industry, what you should say to people in public is that I use both fundamentals and technicals. That is a much more safer political strategy than to say that I believe in pure technicals. In practice, you can always, if you're a portfolio manager, let's say at HDFC Mutual Fund, in practice you can always decide to do what, like say I would do. Let's say if I see a difference between fundamentals and technical, I would always go with the technicals. So nobody's going to examine you at such detail. Okay, what really people will go with is what you say. And so in practice, in public, you say the politically correct thing, which is that I believe in both fundamentals and technicals. That's a safe strategy to adopt. Is this clear? Yes. So we are talking about different types of inputs that I'm giving you at this stage. Okay, so coming back, maybe we lost the thing, but coming back to this fair value versus, so now we have already discussed this point. Basically, they wanted to make sure that the framework is clearly understood. So whenever you're on this branch of the tree, all these approaches, the basic framework you're always applying is you're doing an assessment, not here, okay. You are looking at the market price, you are computing a fair value, okay. Now the computation of fair value, here we come back to Chug's point. The computation of fair value can be done by any of these methods. Either forecast based value, that's why I said your statement is not strictly correct, because you were saying that fair value is always computed. That was the impact of your statement, that you were saying that fair value is always computed using these methods only. That is not strictly correct, because you can also compute fair value according to these methods, okay, and we'll see the difference between these methods and the other the option pricing model as well, right? Is this clear? Now you understood why I said your statement is not strictly correct. So fair value can be computed by any of these three methods, okay. There are basically two broad methods, and then there's a subclass of two over here. Is everyone following so far? They are very important discussions which you'll not find in any book, so make sure these are very important for your fundamental understanding of how to use models and all these forecasting paradigms, okay. These we call forecasting paradigms, okay. This is one forecasting paradigm and this is one forecasting paradigm, okay. Paradigm is just a worldview. It's a way of looking at the world, okay. It's a framework. It's like a high level framework which affects everything that you do, you know, every perspective that you adopt, okay. So what have we understood here? How does this paradigm work? Basically, you look at the market price and you then compute a fair value using one of those three methods, okay, and then you compare the fair value to the market price, okay. I'm stating it in a very amazing, why are we saying such obvious things, but we want to state it like we would state it to a computer. You would compare the fair value to the market price, and if the fair value is higher than the market price, you would buy it, okay. Why would you buy it? Now understand the logic once again, like a computer. Why are you buying it? Because obviously, because you believe, yeah, because what is the belief in this branch of the tree? What is the belief? That eventually, sooner or later, the market price must come to the fair value, okay. And in this case, you see that the fair value is lower than the market price, okay. So in this example, the fair value is higher than the market price, and because you believe that the market price has to eventually move to the fair value, which means the market price, as it's moving to the fair value, if you look at this chart, if the fair value is here and the market price is here, as the market price moves to the fair value, it will have to appreciate. Follow this. We are making it very, very baby steps, okay. Just like we would explain it to a computer, so the logic is clear, okay. Why are you buying? Okay, why are you buying? Because the belief is that the fair value is here, so the market price must eventually converge to the fair value, and as it converges, it will have to rise, not fall, Okay, so if you want to profit from a rising market, you should buy, not sell. Is this clear? Is everyone following? Anika, you're following? Okay. So is this clear now? Stepwise logic. Now you would explain it to a computer. Obviously, for a human being, you don't have to explain in so many steps, but it's always better to learn as if you have explained it to a computer. That makes your basics very clear. Basic logic should be very clear. That's why you're buying, because the price is going to go up, because you believe that it has to converge to the fair value. Is this clear? This is the fundamental driver of this. So similarly, now if we go back and apply, if fair value is less than market price, so here you should sell, because the market price has to converge to the fair value. In this case, it will converge by declining, not rising, and in order to profit from a declining market, you should sell. Okay, so there is also an unstated assumption which a human being would consider too obvious, but you have to state this to a computer when you are programming a computer, is that the objective is always to maximize profits. Okay, because if your objective was to lose money, then in these cases you would buy or sell. Because the computer doesn't know. If you don't tell the computer that the objective is to make money, the computer, human beings are going to understand that, but the computer will not. Okay, so it's always better to understand it from that perspective. Okay, is this clear now? This is how this framework is always applied. Okay, that you're in this branch of the tree, so you are always going to apply this fair value versus market price comparison. Okay, now we come back to our North Delhi sugar problem. Now we see that the market price of sugar is 50 rupees. Okay, and we belong to this branch of the tree because we believe that the market is rational, which means that price must eventually converge to fair value. And we do a fair value computation based on the identical grade of sugar price in Delhi. In South Delhi, we find it's 40 rupees and transport cost is 5 rupees. So we say that the same commodity cannot have two prices. So we can actually, now we can bring this South Delhi sugar to the North Delhi market, bring it to the same location, and that's going to cost us how much? 45 rupees, right? So that is the synthetic price, the synthetic fair value of North Delhi sugar, okay, is 45 rupees. It's not 50 rupees. Okay, is this clear? So what in this situation, what are we seeing? Is price higher than market value or lower? Price is higher than market value, so we are in this box. Price is higher than market value. We are here. Okay, so therefore what should we do? We should sell. Okay, and we should sell, but we are participating in what is called classical riskless arbitrage here. Okay, so therefore we can't have a position left. We need to lock in a profit. So we are going to sell. Which market are we going to sell? North Delhi, the natural North Delhi market. I'm distinguishing between natural and synthetic. I will sell in the natural North Delhi market. But if I sell sugar, that's a contract to exchange assets. That means I'm selling sugar and buying rupees. Okay, so if I've sold sugar, then I have a contractual obligation to deliver the sugar. Where will I deliver it from?
Buying it in the south.
Buy it in South Delhi and deliver it, because when I buy in South Delhi, that's a contract to exchange assets where I will be given sugar. I will be buying sugar and I'll be selling rupees. Okay, so if you see the rupee account, basically here what will happen, you have two accounts. So you have the INR account and the sugar account. Okay, so here you will have, let's say in North Delhi, if you look at it this way, and South Delhi. In South Delhi, what is happening on the INR account? You have, let's say you buy, say 100 kilos of sugar in South Delhi, and here you have minus 100. You're selling 100 kilos in North Delhi, okay, and you're buying 100 kilos in South Delhi, and we'll just assume that, just to make our calculation simple, we'll just assume that the price directly is, instead of factoring in transport cost, we'll just call the price 45 rupees. Okay, so in this case what you're doing 100 minus plus, and so this is minus 45. Yes, you're paying 45 rupees for 100 kilos of sugar, and here it is minus 100 for the sugar account, and here how much is it? Plus 50. Okay, so net, if you see, okay, so this is how your account should look after you have engaged in classical riskless arbitrage in any base asset. Here the base asset is sugar. Okay, so the base asset account should be square. The base asset account should be square, and the profit will show in the terms asset. Okay, is this clear? So you buy 100 rupees here, sugar account goes up 100, here you sold 100, so the sugar account squares out, then the rupee account shows a profit of 5 rupees. Is this clear? So this is classical riskless arbitrage. So you have identified that the commodity is identical. You see the natural market price in North Delhi is 50 rupees. Okay, but then you do a fair value computation, and this is how you do the fair value computation. You're using this method. What you have used is actually this method. Pure arbitrage free valuation. Okay, we'll explain now a little bit more in contrast to option prices. You have actually used this method to compute the fair value, and you came out with a fair value of synthetic fair value of 45 rupees. Okay, basically you asked yourself, how can I, this is obviously the natural price that I'm looking at in the market, okay, the native market price. But how can is there any other way for me to bring sugar to North Delhi at a lower price? Is what you're asking yourself. Can I synthetically create a sugar long position if I believe that the fair value, so I'll be looking to sell, or can I synthetically create a sugar position in the North Delhi market? And the answer to that is yes, you can, by buying it in South Delhi and transporting it to North Delhi, and that's going to cost you 45 rupees. So the synthetic fair value of sugar in North Delhi should be 45 rupees. The market price is higher than the fair value, so the market price in this case is out of line with the fair value, because it should not be 50 rupees. Because for 45 rupees we can produce sugar, and we can bring sugar to the North Delhi market for 45 rupees. Is this clear? Okay, so you're always asking yourself this question. Okay, so here this is the case of pure, what we call classical riskless arbitrage. We'll use this term here. Okay, and we'll call it, the reason I want to use this long term is because we have a lot of examples in the industry of incorrect use of the term arbitrage. Okay, the term arbitrage is used in a loose sense in the industry in many cases. Okay, where there isn't actually this you see is clear riskless arbitrage because there's no risk. Okay, you instantly sell, get the sugar dealer in South Delhi on the phone and contract with him to buy 100 kilos, and in North Delhi you sell in the local market at 50 rupees instantly. Okay, and so there's no risk. Okay, and if these guys don't default on their contracts, you'll get the delivery. Okay, and you can square your position and be left with a clean profit. Okay, so here everything is done instantaneously, and if you look at all the inputs, what are the inputs here? Is the natural market price here, this and this, right? So if we can put it like something like, these are your three key inputs which you need to execute this arbitrage, right? You need to know the transport cost. The transport should be freely available. Okay, and there is no bar on moving sugar from South Delhi to North Delhi, so you can actually make this happen. So the other question you have to always look at is obviously as a matter of practicality. You have to make sure, you may see a theoretical arbitrage, okay, but it may not be possible to execute the arbitrage. Suppose there is some kind of rule, maybe North Delhi Municipal Corporation or something has come up with rules, some regulatory authority. Okay, this could be changed to price of gold in the international markets versus price of gold in India. Okay, the reason you can't do classical riskless arbitrage is because the government of India is putting up all kinds of barriers. You cannot freely move gold, freely move dollars. Okay, so therefore there is some kind of bar on theoretically the arbitrage exists, but you can't in the case of international gold and Indian gold. Okay, theoretically there is an arbitrage by looking at the dollar rupee price and the international gold price. We showed you the other day, remember we discussed it, but you can't actually make it happen because the government of India puts up all kinds of restrictions on free movement of gold. There can't be any restrictions on free movement of gold, free movement of dollars and rupees. Everything should be able to flow freely. Only then can you make it happen. Are you able to follow? Like if here the municipal corporation puts up some barriers, you can't move sugar from South Delhi, then you have a problem. Although you can see that the price from South Delhi, if I bring it, the synthetic fair value is 45. Okay, but actually you can't actually execute this arbitrage because the municipal corporation in North Delhi has put up some barriers on the movement of sugar from South Delhi. So you can't make it happen. If you sell in North Delhi at 50 rupees, you have to deliver against this. You can't bring the South Delhi sugar and deliver against the short position. because the regulatory authority, the regulators have basically blocked it. So in all situations, you have to see first of all whether there is a theoretical arbitrage. Then you also have to see whether, based on the situation on the ground, are you allowed to actually make it happen? Is this point clear? When both are clear that there is a theoretical arbitrage and there is no regulatory or other kind of barrier to making it happen, to executing the arbitrage. Are you able to follow what I'm saying?
Yes.
Yes? When there is no regulatory barrier to making the arbitrage happen, then you can see clearly that it can be executed. Then you are actually in this box where you're following this method. Then you are in what is called this AFV stands for arbitrage free valuation. I don't know if I put it here, where arbitrage free valuation, but we can just put it here. We'll just I'll just put in a note. AFV stands for arbitrage free valuation. So why is this arbitrage free? One sec. Let me also explain this. This is a very important principle in valuation in finance. So this you will see one of the problems of many of these. So Tanya, you never sent me that syllabus of the course that you're doing. Send me the syllabus. I don't think they're covering. Are they covering arbitrage free valuation? Okay. So this is one of the problems of many of these courses, is that they would not. One sec. Let me just merge this. Yeah. Okay. So AFV equals arbitrage free valuation. Okay. So arbitrage free valuation here, what happens is that this is one of the valuations. So when you study valuation, pay attention. Okay. When you study valuation, you have to understand, usually what happens is most of the valuation discussion happens in this column. Okay, these kind of techniques. Okay, but you also have to be aware that there are other techniques of valuation. So arbitrage free valuation is a very different technique, and let's also distinguish it from forecast based valuation. Okay, let's understand this. Okay, so first thing we have learned is that you can only be in this branch of the tree when there is no barrier. That there should be a theoretical arbitrage, and there should not be any kind of barriers preventing you from actually executing the arbitrage. Like here in this case, the arbitrage transaction, the classical riskless arbitrage transaction, is where you sell North Delhi sugar and you buy South Delhi sugar, transport it and deliver it against the short position in North Delhi. Is this clear?
Yes, sir.
Everyone is clear? Okay. This is a classical riskless arbitrage case, because look at the inputs that went into your valuation. Now look at the inputs that went into your this one is very clear. This is always objective. Market price is always objective. This is never a problem. Okay. Now let's look at the ingredients of your fair value model. What are the ingredients? The market price and the transport costs. Both are known. There is no assumption involved. Everything is known, and you are not prevented from executing the arbitrage. Okay. So this is why these are all basically, you see, there is no forecast involved. Can you see this? Why am I contrasting this valuation method to forecast based valuation? Because here there is no forecast. Can you see that? There is no forecast involved. This North Delhi market price visible, South Delhi market price visible, transport cost known. So in my fair value model, what is this? My fair value model is a very simple model. Even A plus B is also a model. Okay, everything, any mathematical expression will be a model. So this my fair value model, the components, the exogenous variables in my fair value model, they are not based on any forecast. Are you able to follow this? They are based on observable prices. This is the price in South Delhi, this is the price for transport. Are you able to follow? They are observable prices prevailing right now, which I can lock into. This is clear? Okay. So that is why this is different from what you just did, what we call classical riskless arbitrage. Okay. That you are able to do this and pick up this 5 rupee profit, and I'll explain what AFV is. Okay. But the point here is, first understand the difference between, are you able to follow the difference between this and this? All your project NPV that you did it involve forecasts? The exogenous variables? Tarun is saying none of the exogenous variables were forecast. When you are doing project NPV, are any of the exogenous variables forecasts?
Yes, sir. Yes.
All forecasts? So why have I called these bonds, stocks? Okay, there is an extreme case here, but although we saw something has happened to this volume.
Yes, sir.
Should I take it out?
Yes, sir.
I think it will be better.
So,
Lower it. Yeah, this is better, I think. Yeah, good. Okay, guys. So let's please understand, these are all important concepts to understand in valuation, and you will not find this in any book. So better understand it clearly now. Okay, why am I distinguishing between these? Now we have looked at a very simple case. We can look at more complicated case like valuation of FX forwards, valuation of FX cross rates. These are all applying the strict method of AFV. Okay, true AFV. You can call it true or proper AFV. Okay, and why am I distinguishing between this? We'll come to options later, but why am I distinguishing with this and this? Why am I calling all this forecast based valuation? All this stuff that you did, all is based on forecast. Can you see that? In all of these cases, what was true? That using our model lingo once again, that the exogenous variables, one or more exogenous variables, were based on forecasts. Do you understand? Do you agree? In all these models, one or more exogenous variables, you remember now, Surabhi, what is the exogenous variable?
So, which are independent. Inputs which are independent.
Okay, good. So in all these models, is this clear? All these models, the Gordon growth model, okay, your other stock valuation model, discounting earnings, project NPV, IRR, everything it's always true that the exogenous variables, one or more exogenous variables, are forecasts. Now forecasts are obviously, is it guaranteed that your forecast will come true? No guarantee. Okay, so therefore there is a high level of uncertainty with these models. That's why you have so many cases of losses. People have done like $47 billion mergers. They bought, like, there's a very famous TXU, which is a utility. KKR and Goldman Sachs went and bought this Texas utility, and then it was $47 billion. It was a $47 billion buyout. Okay, it was a leveraged buyout. And eventually that utility had to go bankrupt because that was a natural gas. They were affected by natural gas prices. Okay, they are adversely affected by declining natural gas prices, and that's exactly what happened. So in their modeling of the fair value, they would not have factored in that kind of decline in natural gas prices. They thought it would be much more normal or contained. Okay, but in real life, of course, anything can happen. Okay, so that's why you have these losses. That's why there's a high level of uncertainty. Now notice this is arbitrage free valuation in this box. Okay, people are getting restless. Okay, 1 minute. We'll just take 2 minutes. Just one sec. Wait. I won't take too much of your time. I'm very conscious. You need to eat and refuel. Okay, 1 sec. 2 minutes, guys. So here you can see there is no uncertainty. Okay, we locked in everything. The profit is in our bucket. There is no uncertainty. Okay, now why is this called arbitrage free? I'll just finish this one point and then we'll close the class. Why do we call this arbitrage free valuation? Because the technique that I used is arbitrage free valuation. What did I say? I said that I looked at it, I saw that there is a theoretical arbitrage because I see South Delhi markets and I see there is no restriction on executing the arbitrage. So I say that, okay, theoretically we can do this, we can make it happen, and we come up with a fair value. The synthetic fair value is 45. Okay, now if the market, so this fair value is an arbitrage free fair value, because if the North Delhi market had been priced at 45, why do we say arbitrage free valuation? We say that the 45 here represents arbitrage free value. Okay, the valuation of 45 will be arbitrage free valuation. Okay, why? Because if the North Delhi price had been set at this level, the 45 level, yes, if it had been set at 45, there would be no opportunity for arbitrage. Yes. So therefore this value, if the market price is equal to the arbitrage free valuation, then there is no opportunity for arbitrage. That's why we say it's arbitrage free. Like you eat some products which have gluten free, so that means that there is no gluten in that. Okay, so similarly arbitrage free valuation, in this valuation, if you could set the price equal to this valuation of 45, there is no opportunity for arbitrage. That means there is free of arbitrage opportunities. Is this clear to everyone?
Yes, sir.
That's why we use the expression, but this is a classical finance expression, so you should understand it. Arbitrage free valuation. Now make sure you understand why we say it's arbitrage free. You should be able to explain it. Is this clear? Okay, you can go and eat. Yeah.
So EPM where you said that we control the price limits. Why don't we trade the price limits? Are
Yeah. Exchange traded markets, you have price limits. Yeah.
So then how can you say that the markets are free? And it's the same scenario like we in India we control the beta stock prices.
Yes, you're right. So for a purist free marketer like me, that's why I said the advantage of OTC markets is that you don't have any restrictions. In OTC markets, I gave you the example of what actually happened. Okay, that you had where the Gorbachev coup happened in 1992, and the dollar mark went shot up and started moving in a very abnormal way. Like normally it trades at like 5-point spreads. It started moving in 200-point spreads. Bid and offer were 200 points apart, and the market price started shooting up. I forget what the unit for the Deutschmark was. Anyway, 5 marks, 2 marks, 5 marks, 7 marks, 8 marks. It started shooting up. It was a very abnormal movement, but there was no regulator. What eventually happened was that the central banks came in and intervened. So you can have that kind of, but that intervention is not planned and it's not guaranteed. The exchange price limits are guaranteed. That if it goes to 5% or whatever the limit is, they will stop trading. So there's a big difference between exchange traded markets and OTC. In OTC, if you see some dramatic movement, you may fear that okay, central banks will now come and intervene, but there's no guarantee that will happen. Here it's guaranteed. So yeah, you're absolutely right that for a free market purist like me, I don't believe in price limits. I don't think they should have price limits. But you know why they need to have it? Because remember their margins? Their margins. Yeah. So there are certain vol forecasts built into the margins. So I have taken, let's say, $10,000 per contract margin from you, because I have assumed that prices will move in a certain limited way. Now if all prices start moving like $50 in a day, now that's going to throw, then you may lose a lot of money, and that $10,000 margin deposit not sufficient for me to recover losses if you default. So that's one of the reasons they do it. Okay, that limits. But also there's all kinds of politically correct rubbish going on also. That markets should not fluctuate and all this rubbish. So yeah, so for a purist free marketer, this is not acceptable. But because they have margins, they have to. It's part of the reason why they have to do that. Yeah.
So I wanted to ask, are there any additional decision problems for the future contracts? Like,
Are there any extra decision problems?
yes, or they are same like options and.
See, the broad decision problems are the same. There are only 2 classes of decision problems. Either one for the risk books, which is what you guys have done so far, your stock trading, your options trading, equity options trading. These are for risk books. Now the active risk books, okay, speculative books. And then now we'll be in this project, we'll be looking at hedging books, which we call passive risk books. So there are the same decision problems exist, okay, but some of them are automatically solved. So the generic decision problem, obviously the other thing is like in futures contracts, just like options, you have which month should I trade, right? So there for that you will typically look at volume, okay, and try to decide which is the more active month. Just like your options, you choose more liquid contracts. So those decisions, because futures have many months, right? So you have to decide which month are you going to trade, which contract are you. So that is an obviously decision problem that will remain. But those are slightly subsidiary problems. What we have listed initially is all the basic generic decision problems. Is clear? So in the case of options, you obviously have strikes. So those obvious additions will come. But by and large, there is no generic decision problem that we have left out.
But level of priority can be changed. Like here we have to think about which month, like that is more important to us.
Yeah, you can. It's not really a priority. Initially, you typically what happens is you always, depending on the contract, you will have a way of deciding. Especially when you're speculating. If you're a hedger, then it's different because you have to decide what. If you're hedging, let's say your December crop, if you're a wheat farmer, then you will obviously trade in the wheat December contract. right? So that's a different kind of thinking. But if you're a speculator, you're generally driven mainly by liquidity. So you will look at volume, and here you see volume is given here. So in this case, what I will do is, let's look at this contract. What is this? Crude oil. Okay. So I look at this as a speculator. Okay. If I'm, let's say, so that we can look at both here. So if I'm a speculator, I will just look at this volume and I see that the Jan contract has the most volume. Okay. So then I'll just go, I will trade in the Jan contract. Okay. But if I'm a hedger, let's say I'm ExxonMobil, I'm trying to hedge my production for July 2020. The production which will come on stream, well, there's not even a price for that. Let's look at June 2020. So if I'm trying to hedge the production, so when you're hedging specific types of production. June production, May production, winter crop, summer crop. Okay. So if I'm a hedger and I'm hedging my June 2020 production, then I will trade in the June contract. So the hedger's thinking is a little different because it's based on what you are hedging. Okay. So you'll see that some of the decision problems are automatically solved. So there are some small nuances, but by and large, the major decision problems remain the same, because futures is just an instrument. So it has certain quirks, like just like options, you had these additional problems of strike price and which contract, which maturity of the contract, longer maturity, shorter maturity, because that's how options are structured. So additionally, but as in the case of spot, you have only buy or sell. So based on the instrument, you have some additional complications. Okay, but the basic decision problems are the same. Yeah.
And sir, also, like why should we bother to invest or like buy or sell future contracts? Because there's a predefined date for the settlement of the underlying asset buy or sell, but it is on today's money, right? Like the money which is today. So the value of money can change or with the time, as you say. So that particular contract might increase in price or decrease in price, or time value can change its money value. Sorry. So why should we bother to invest?
No, I didn't follow what you're saying.
Why should somebody?
So why should you trade futures as opposed to what? As opposed to spot?
Yes, sir. Spot or options. That's what.
No, because spot. Remember, spot. The delivery is two business days typically. Okay.
Yes,
so you may not be interested in that kind of delivery. In certain cases, when you are speculating, like for instance, crude oil. Okay. Think of it from a speculator's point of view. You are saying you have set up where either spot or futures, and you're saying why bother with futures? Why not trade spot? But if you're trading spot crude oil, you have to take delivery.
Yes, sir.
Okay, your trade delivery. In that case, what will happen is, what will you do with the cargoes? If you are just a speculator sitting at home and speculating, then you are not interested in oil cargoes. You're not interested in physical delivery. Okay, if you trade in futures and you get out before the first notice day or the last trading day, okay, whichever is earlier, then you don't have to bother with physical delivery. And the advantage in futures is the futures are very, very liquid. See, advantage is, if you want to trade in physical oil cargoes, you will have to call up some physical dealer like Trafigura or somebody and contract with them. I want to buy. Then you have to talk about tanker size. There are different types of tankers, Supramax, this, that. There are, I think, 3 or 4 sizes of tankers. Which tanker do you want to buy? What size of tanker do you? So there's a lot of headaches. Physical oil. What will you do with the oil? But if you're a speculator, okay, these markets are very liquid. Crude oil is very liquid. You can see how tight it is. Although this is North American crude, right now even Frankfurt hasn't come in, and you see how tight the spread is. 1 cent spread.
That's why I'm saying the money value will change now with time.
What money value will change? You mean the price of the
like today the price is 57.84. Then we have a predefined date, like after 1 year, after some time.
Yeah, it's Jan 20. Yeah.
After some time we'll get the contract.
You get the delivery.
You get the delivery. But at that time the price is much higher, so we are at loss.
Could be higher or could be lower.
We are at loss until.
Yeah. But no, remember, in futures the loss is going to be settled on a daily basis. So you are not even settling at the end. And remember, the idea, the main reason for, see, there are two ways of thinking. Either you're a hedger or a speculator. Okay, and we're not talking about market makers. We're talking only about directional speculators. So if you're a hedger, then obviously you will trade based on you will trade futures because you're hedging future production. If ExxonMobil is hedging May 2020 money production, it will not sell spot cargoes because it can't deliver right now. It is hedging what will come out of the ground in May. So they are hedging this. So you can see the value of this for futures, for hedgers. Okay. For speculators, the advantage is that these markets are very liquid. Okay, these are very liquid markets. So what is my objective? You think about a speculator's thinking. The speculator's thinking is that basically that I have a view on, I'm just speculating on oil. Okay, I have no interest in buying oil and putting it into the refinery or anything. I am just speculating on oil. So I look at the chart and I see that my view is the oil is going to shoot up to 76. Then what I do is, for me to make money on that view, इसको रहने दीजिए अभी, ये ना वो ठीक है अभी, for me to make money on that view, okay, what is the best way for me to make money? If I buy a physical cargo of oil, I will have to take delivery and sit on that cargo till this move happens. Maybe the move will take 3 weeks.
Yes, sir.
So where will I keep that oil for 3 weeks? So it's a lot of headache. But these markets, you see, futures markets are very liquid. So I have no intention of waiting till Jan 2020. My goal is, I have a view that within the next 2 weeks, oil prices will shoot up to 76. So the most liquid way to trade oil is futures. These are, you can see how tight the spreads are, very liquid. Okay. So what I'll do is, I'll just quickly buy oil futures here and I'll wait. Okay. As the price starts moving up, every day I'm making more and more money. And if I'm losing money, remember, I have to pay my losses every day because it's a futures contract. So the daily settlement, right? So every day. So for me, if I want to speculate, this is the best way to do it.
But if
Very
you don't
liquid.
want delivery, then it's
Yeah, so I just make sure I get out before the last trading day or the first notice day, whichever is earlier. So this tells me, it gives me the best of both worlds, because as a speculator, one of the things I want to always do is, I want to trade in liquid markets, because in high volume liquid markets, what do I get? I get a very tight bid offer spread. See, suppose I buy this at 85 and somehow I change my mind and maybe the price has not yet moved. I can sell it off at 84, my loss is only 1 cent. But if this was not a liquid market, if the bid was say 57.70, then I'm losing 15 cents. Right? So liquid markets are always favored by speculators because you can get out in and out at a low price, low cost. Now you see the value of meaning of transaction cost. Okay, if you change your mind, you can get out and do the opposite trade. If the spreads are tight, you don't lose much. If the market hasn't moved, you don't lose much, right? So this is why people would use futures, because in many cases futures markets are very liquid and they allow you to, if you are a speculator, they allow you to avoid having to take delivery, and basically you can speculate on your, you can give effect to your market view. Your market view is going to shoot up. It can happen, as you've seen here. Sometimes this is when the oil strike happened in Iran. The Saudi tanker facilities were hit, I think. That's when it happened. Okay. So if this can move very dramatically. So if it moves, when it goes up to 76, you just square out your position. You pocketed your profits and you're out. Clean money. No need to bother with oil tanker cargoes. This is clear? Okay. All right.